The statement by the U.S. Securities and Exchange Commission (SEC) Chair Gary Gensler at an investor advisory committee meeting suggests that crypto exchanges may not be considered safe qualified custodians for investment advisors. Gensler was commenting on a recently proposed rule directing investment advisors to look to qualified custodians for the storage of assets, including cryptocurrencies, which he said made important enhancements to existing protection rules. Gensler cautioned that investment advisors cannot currently rely on crypto trading and lending platforms as qualified custodians due to how they generally operate. He emphasized that just because a crypto trading platform claims to be a qualified custodian does not necessarily mean that it is. Gensler cited recent bankruptcies in the crypto sector as evidence that customers' property held on those platforms is now part of the bankruptcy estate, rather than returning directly to the customers. The proposal aims to expand the custody rule to cover all of an investor's assets, not just their funds or securities, in response to Congress's 2010 provision to grant the SEC new authorities to expand the custody rule in the wake of the financial crisis and Bernie Madoff's frauds. The expanded custody rule would help ensure that advisors do not inappropriately use, abuse, or lose investors' assets. In light of the FTX controversy, the Securities and Exchange Commission (SEC) has seized the opportunity to intensify its scrutiny of cryptocurrencies. The agency believes that tighter regulations are necessary to protect individuals from suffering the kind of financial harm that was seen during the FTX incident. The extent to which these new policies may exceed the jurisdiction of the SEC remains a matter of debate. Nonetheless, it is apparent that not all stakeholders are content with the proposed measures. In this video, we would explore the latest SEC policies and how it affects not only the crypto asset themselves, but also the exchanges. Stay tuned and make sure to hit the like button, subscribe, and drop your comments in the comment section below. Last month, the U.S. Securities and Exchange Commission (SEC) enacted a rule that required registered investment advisors, or IAs, to store their digital assets outside of the cryptocurrency industry. The rule was approved in a 4-1 vote by the SEC and was the agency's first formal policy push that dealt heavily with the cryptocurrency sector. The rule expanded on the SEC's existing regulations that stated investment advisors must keep customers' money and securities with a qualified custodian. Under the new version of the rule, which was approved, any assets entrusted to investment advisors needed to be safeguarded, including cryptocurrencies. Prior to the enactment of this rule, crypto trading and lending platforms often offered custody for crypto customers, but they did not meet the requirements of a qualified custodian under this rule. A qualified custodian under SEC regulations would typically be a chartered bank or trust company, a broker-dealer registered with the SEC, or a Futures Commission merchant registered with the Commodity Futures Trading Commission (CFTC). Although SEC officials stated that the rule was not specifically aimed at the crypto industry, they did mention the sector heavily in their formal remarks about the proposal. This move by the SEC was seen as a step towards greater regulation of the cryptocurrency industry and towards protecting investors in this emerging asset class. The SEC's proposal aims to ensure that investment advisors only trust regulated financial institutions with their customers' crypto assets, excluding crypto businesses that are not under SEC regulation. The qualified custodians would need to comply with strict rules such as undergoing independent audits, regular disclosures, and segregating customer assets into accounts under the customer's identity. This proposal is a response to the need for greater regulatory oversight of crypto custodial issues, which have been a concern for some time. The agency has been working on this proposal for a long time, predating the recent crypto market spectacles. The SEC's action is part of its mandate under the 2010 Dodd-Frank Act, which overhauled the regulatory landscape after the last widespread financial collapse. SEC Chairman Gary Gensler has voiced his concern about the lack of proper segregation of investors' crypto assets by some platforms, leading to the commingling of assets with the platform's crypto or other investors' crypto. This practice puts investors at risk when these platforms go bankrupt, leaving investors' assets as the property of the failed company and leaving investors in line at the bankruptcy court. One commissioner, Mark ADA, raised a valid point that the SEC's proposal may make it difficult for advisors to invest in crypto assets through banks, especially as bank regulators have cautioned banks against the crypto activity. This proposal may inadvertently block crypto activity through advisors, which would be counterproductive to the SEC's goal of investor protection. Despite this concern, the commissioner chose to support the proposal, which suggests that the SEC is likely to continue to pursue greater regulatory oversight of the crypto industry. In some ways, Gensler's own crypto rhetoric makes this proposal less dramatic. The SEC chairman has already said most tokens are securities that should be registered. Under the existing rules for investment advisors, securities already need to be in the hands of qualified custodians. So in Gensler's view, the current standards already affect the vast majority of digital assets. If he's right, this revision effort just swoops in and makes sure there's no crypto asset left out. The latest proposed rule leaves some questions about the role of companies like Anchorage Digital, which is a crypto-oriented trust regulated by the Office of the Comptroller of the Currency, OCC, or state-chartered institutions such as those in Wyoming. SEC officials said as long as a company can meet a list of requirements, they can seek to act as a qualified custodian. Proposed rules don't always make it to the finish line. The agency is scheduling a 60-day comment period during which the crypto industry is certain to make itself heard. The SEC will have to review and consider the outside input, which is typically a months-long process. The SEC will then have to write and approve a final version of the rule before it can be implemented. The SEC has sought public input on custody issues before, such as a request for comment in 2020 after Wyoming said a state-regulated entity may be a qualified custodian. No formal policies were proposed at the end of that comment period. Do you think this policy would be enforced by the SEC? Let us know your thoughts in the comment section below. Also, make sure to hit the like button, subscribe, and turn on notifications for future videos. Thanks for watching.